Hey everyone, welcome back to Corporate Decoder, the place where we decode the often confusing world of corporate filings. Today, we're diving into a Form 8K from T-Stamp Inc. And let me tell you, it's not about stamps in the traditional sense. Think digital identity and security, not licking envelopes. This report signals a move to raise more cash, which could be a lifeline or a sign of deeper challenges. We will see. The report is dated February 25, 2025. This is the day T-Stamp made a deal that could change how they fund their operations. T-Stamp Inc. is the company we are covering today. They are based in Atlanta, Georgia. The company works in the world of digital identity. They create ways to verify who you are online. They trade on the NASDAQ, the stock market, under the ticker symbol IDAI. Now let's get to the meat of the report. Item 1.01 talks about entering into a significant, definite agreement. This usually means something big is happening. Specifically, T-Stamp entered into an equity distribution agreement with Maxim Group LLC. Basically, this agreement allows T-Stamp to sell shares of its stock through Maxim. Maxim will act as the sales agent or even buy the shares themselves. These are regular shares of the company. They're selling something called common stock. Each share has a value of $0.01. Maxim Group LLC is the company helping T-Stamp sell these shares. Think of Maxim as a middleman that will use its resources to sell T-Stamp shares. Maxim can act as a sales agent, meaning they sell the shares on T-Stamp's behalf. Or they could act as principal, meaning they buy the shares themselves and then resell them. Maxim promises to use commercially reasonable efforts to sell T-Stamp's stock. This means they'll try their best, but there's no guarantee they'll sell everything. The method they'll use is called an at-the-market offering. This means they'll sell the shares at the current market price. It is flexible for the company, but they do not get a fixed price per share. The agreement is subject to the U.S. Securities Act of 1933. This is a law that protects investors by requiring companies to be transparent when selling securities, like stocks. For their services, Maxim will get a commission of 3.0% of the total money raised from selling the shares. So, for every $1 million raised, Maxim gets $30,000. Also, T-Stamp will reimburse Maxim for some expenses up to $40,000. On top of that, T-Stamp will pay up to $3,000 each quarter for Maxim's lawyer fees, along with other small expenses. T-Stamp also agrees to protect Maxim from certain legal liabilities, including those under the Securities Act. This is called indemnification and contribution. It's basically an agreement to cover Maxim's legal costs if something goes wrong. The agreement ends when they've sold shares worth $6,196,000 or after 1 year. It can also be terminated earlier if both companies agree or if certain other conditions are met. T-Stamp already has a registration statement on file with the SEC. This document, called a Form S-3, allows them to sell shares to the public. The SEC declared it effective in April of the previous year. They also filed a prospectus supplement or ATM prospectus with the SEC. This document provides more details about the stock offering. The sale of shares is also subject to something called baby shelf limitations. These limitations are described under General Instruction IB.6 of Form S-3. The baby shelf rule restricts how much a smaller company can sell in a certain timeframe. This rule is designed to protect investors and prevent too much stock from flooding the market at once. The full agreement is included as Exhibit 1.1. If you want all the nitty-gritty details, you can find it there. This report is not an offer to sell shares. It's just a notification that T-Stamp has entered into this agreement. Finally, there's a section on forward-looking statements. This is where T-Stamp warns that the future is uncertain. Anything they say about their plans is just an estimate. Actual results could be very different due to various risks. They point you to their most recent annual report on Form 10-K for a list of potential risks. These risks could include things like competition, changes in technology, or economic downturns. Now let's move to the exhibits. These are the documents that provide additional information about the agreement. Exhibit 1.1 is the equity distribution agreement itself. This is the main document we've been discussing. Exhibit 5.1 is the opinion of CrowdCheck Law LLP. This is a legal opinion confirming that the stock offering is legal and valid. The report is signed by Gareth Jenner, the CEO of T-Stamp Inc. By signing, he is saying that the information in the report is accurate to the best of his knowledge. So what does this all mean? It looks like T-Stamp is trying to raise money by selling more shares of its stock. This can be a good thing if they use the money to grow the company. However, it can also be a sign that they're struggling to generate cash on their own. One risk is that selling more shares will dilute the value of existing shares. This means that each share will be worth less because there are now more shares outstanding. On the other hand, if T-Stamp can successfully use the money to grow their business, it could be a great opportunity. They're in a growing market and they have a unique technology. Now let's talk opinion and analysis. T-Stamp seems to be at a critical juncture. They're in a hot sector, digital identity, but they need cash to fuel their growth. This agreement with Maxim could be a double-edged sword. If they execute well and the market responds positively, it could propel them forward. However, if they struggle to deploy the capital effectively, it could signal deeper problems. It's worth noting that their reliance on raising capital through stock sales could indicate a weakness in their current business model. Are they generating enough revenue to sustain themselves, or are they dependent on outside investment? That's a key question for investors to consider. One of the notable risks here is market sentiment. If investors lose confidence in T-Stamp, the stock price could fall. This would make it even harder for them to raise money in the future. In conclusion, T-Stamp's move to raise capital through this equity distribution agreement is a high-stakes gamble. It could pay off handsomely if they can execute their growth strategy effectively. But it also carries significant risks, particularly for existing shareholders. Thanks for tuning in to Corporate Decoder. If you found this analysis helpful, please like, comment, and subscribe for more deep dives into the world of corporate filings. What are your thoughts on T-Stamp's strategy? Let me know in the comments below.